In this video, I wanted to talk about the concept of basis. It's very important in the calculation of taxes to understand what basis means, what your basis is, and then what type of capital gain could apply to your particular situation. Knowing this information will help you make better decisions with regard to how long to hold your assets and what kind of taxes you're going to pay after you liquidate those assets. So typically speaking, basis means the amount of the investment that you have in property for tax purposes. So it's used to calculate gain or loss on the sale, exchange, or other disposition of property. So let me give you an example. It typically applies to stocks, bonds, crypto, collectibles, but most importantly, real estate. So let's use real estate as an example. Let's say you buy a home for $250,000 and then you put $50,000 worth of improvements into the home. This is fairly common. That would equal $300,000 investment. And then 2 years later, you sell the house for $500,000 and you made $200,000. If assuming that you held that property for more than 1 year, a year and a day, it's going to be subject to what are called long-term capital gains, and you're going to pay tax on the profit. So in this case, in this example, it would be $200,000. Now let's assume this was not your primary residence, because then different rules apply. But that would be the answer there. Now it's important to know you're going to get a 1099-S after closing, and it's going to have the sale price on the 1099-S. So in this case, it would have a sale price of $500,000. It's very common for taxpayers to leave off the sale of the property off of their Form 1040, and then they're going to get a CP 2000 letter that says, hey, you owe us short-term capital gains at the ordinary tax rates on this $500,000, big giant number, and you need to go ahead and agree to this letter and pay us. At that point, it'd be a good idea to call a tax attorney, because you only have a limited time to respond. And your basis, let's assume your basis was the same as in my example. Assume your basis was $300,000. You would have a basis of 300, the sale price is 500. You would pay the long-term capital gains tax on the $200,000. You're going to want to take a look at the long-term capital gains tax brackets in the year that you're watching this video as well, because they can be very advantageous. At the time of the filming of this video, there was a 0% bracket, a 15% bracket, and a 20% bracket. These are all advantageous over what we call short-term capital gains. Short-term capital gains are taxed at ordinary income tax rates. So if you're in the 35% bracket, you're going to pay tax of 35% on that short-term capital gain. And a short-term capital gain is the sale of an investment that you held for less than a year. So you see this quite often when you have people that are day trading in stocks, or in and out, in and out, in and out, in and out of positions. Those are all going to be short-term capital gains unless they held the stock for more than a year. I would prefer to say a year and a day. So that's the concept of basis. It's really important to know about. I'm going to throw in a little bonus here too. There's the concept of stepped up basis. Well, when do you get stepped up basis? Well, you get stepped up basis when you inherit when you inherit an asset. The stepped up basis means that at the time of the decedent's death, at the time of the death of the person who gave you the money or gave you the asset when they died, your stepped up basis is the basis on the day of their death. And so this is really important. Let's say your parents bought a house 50 years ago for $10,000. That house is now worth $1 million, and they leave you the house. It would be really not very advantageous if you had to assume their original basis of $10,000. Instead, if the house was worth $1 million on the date of their death, you sell it a week later, you're going to get the stepped up basis of $1 million. What happens if you hold that asset? You don't sell their asset, their home, until 5 years later. Well, let's say in 5 years later, it's worth $1.2 million. You got the stepped up basis of $1 million. You made a $200,000 profit. You're going to pay long-term capital gains on the $200,000. Hopefully this video helps somebody out there. If you're interested in this and other tax issues, you can give us a call at 888-438-6474 or visit our website at getirshelp.com.